Joining us here at Post 9, Goldman Sachs Chief U.S. Equity Strategist David Kostin is with us. Did a lot of good work on this rebalance and sort of what it means historically for some of the largest names in your note this week.
So one of the things that is interesting, it's only the second time in 25 years that the NASDAQ 100 index is being rebalanced. Last time was 2011, and it took Apple from 20% to 11%. And this time what they'll be doing is taking the largest stocks in the index and reducing their weight. Because it doesn't really reflect, at some point, the top 7 stocks, Carl, were about 56% of the index, and now they're going to be down around the mid-40s, about 44% by our estimates. And so that's going to take place next Monday morning. And so one of the issues that we think about is, what does it mean for a passive investor? And one of the challenges is, as an index, only 20% of active mutual fund managers are beating the benchmark. And the reason for that is that these large stocks have been lifting the market, and that's making it challenging. It's really difficult for an active manager to own a index weight in those stocks. They're going to be reducing the benchmark. I think it'll make it slightly, not lower, make it easier, just be a more representative, a broader market. And I think that has major implications for the broadening of the rally. It's just not the few stocks that are going to be leading going forward. We need to have, once they need to, if one has a breadth expansion and you have more companies that participate in the rally, then you could see the index move generally higher.
So, but it's not pushing you to move any targets.
No,
for this year or next.
And this is a challenge because right now the S&P 500 around 4,500 is at our year-end target, and it reflects in our assessment the idea of the economy continuing to grow. The idea of a 2% GDP growth is consistent with our economics forecast, but more importantly, if we look at cyclical stocks relative to defensive stocks, that's trading or pricing at roughly a 2% GDP growth in our estimation. So based on the market is fairly valued, and that's kind of how we think about it, which makes it challenging to choose individual stocks. We're coming in on earnings season. Obviously, you've been talking about that this morning, and you basically are in a situation where expectations have really diminished. They were expected to be down 6% year over year. Now it's expected to be down 9% on earnings. I think that's likely to be better than feared, and that's one positive development, if you will, if we look out.
So what do you do then? You take some chips off the table?
So value, the market trades at extremely elevated multiple, and therefore, in order for the market to move higher, fundamentally, it would require earnings to kind of lift that. That's one approach. So you look at the faster earnings growing companies. The other is to think about valuation. Since there's not that much opportunity and the valuation of the overall market, where inside the market do we find that? Healthcare stocks, particularly energy's the cheapest stocks they've been relative to the market in 30 years. So that's some value. So think about value cyclicals. Another way to think about that, some capital goods companies, the economy continuing to improve. Some of the economic data that we look at, Goldman, would suggest the economy is getting better and continuing to grow, likely to avoid a recession in the next 12 months. If that's the case, cyclical, some of the capital goods companies, non-bank financials likely to do better, and some of the semiconductors.
If you strip out the Magnificent Seven, the multiple looks a bit different. I know you've done a little work on that. Is there a way that investors should be thinking about that, David, in terms of the impact that this Magnificent Seven's had on not just the multiple, but overall the actual market weight?
So you are entirely correct. It has been a difficult market this year, and you've chronicled this on your show and others as well. The market trades at around 19 times forward multiple. Those big stocks that you referenced, those Magnificent Seven, trade at 31, 32 times forward earnings. The rest of the market, excluding those, around 17 times. So a little bit of a catch-up. That's why value would suggest if you had some expansion in multiple for the non-leading stocks, you could see the market move a little bit higher. And then look out 12 months from now, market valuation around 4,700, so a couple hundred points higher than we are today. That's kind of how I think about the intersection between the Magnificent Seven, if you want to use that term, and the other 493 stocks.